this. Hello and happy Monday. Welcome to Purse Strings Luncheon or Money Monday. My name is Maggie and I am a partner here at Purse Strings. We are all about providing tips, tricks, information to get those wheels turning about all things money. And then when you're ready to start investing, get a will, get a trust, sell your home, buy a home, get divorced, whatever transition or transaction you are going through, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Dale is one of them. So we're excited to have him on today and talk about this year. I'm going to get into the stock market. It's a very exciting goal. But before we even dive in there, Dale, could you give us a little intro of who you are and what you do?
Yeah, you bet. Thanks, Maggie. So my name is Dale Terwedo. I've been a financial advisor this is my 40th year doing this. So a lot has changed in those times. Yeah. But we have our own registered investment advisory firm, and we can talk about what that means if you want. But the whole process that we utilize is one about having clients make long-term success stories. It's one thing to try to, hit a home run in the market, for example, but it's another thing to actually win the game long term. So that is what we're all about. And so the topics we're going to talk about today are going to be along those same lines that we would give to our clients. We're a fee-based advisory service, and our primary office is up in Edmonds, just north of Seattle, Washington. But I'm also in Central Washington and speaking to you right now from Arizona. And yes, it gets cold in Arizona. I mean, I think it's only going to be 50-something degrees today, which is cold for here. So, and it's rainy too. But anyway, so half the year I'm here, half the year I'm up. And that's what we want for you. We want you to be able to live the life that you want and the way you imagine it. If that's multiple locations, that's great. Whatever it is, that's our goal.
Well, mine's going to be to get out of the 17-degree weather that I'm in and start complaining about 50. No.
You could go to Canada and 17 degrees there is really warm because that's in Celsius.
That's true. Very good point. But no, we're excited to have you on today, Dale, and talk about this year. I'm going to get into the stock market. And for anyone tuning in live, please, if you have any questions, feel free to throw them in the chat. If you're tuning in the replay, you can still put them in the comments. We're happy to come back and take care of those for you. And Dale, as doing this for 40 years, I'm sure you've seen the stock market high and low and everything in between. So I know you have some experience in this area from all that you've seen through your days.
Yeah, we call it the certainty of uncertainty. And what that means is this: we are uncertain what the market's going to do tomorrow. We are uncertain what the market's going to do in the next month, next quarter, next year. And we're certain that's going to happen from time to time. It happens in waves. And so the plan is to have smart money decisions to where you're using money in the right way, and that's to your best advantage. There's a problem with our society in that we are a get-rich-quick type of society where people are always promoting their books, their newsletters, or whatever else that are going to give you the tips. Now, just think about it logically for a moment, and that is this. If you had the secret to making the market work for yourself, would you tell anybody else?
No.
I don't think so.
No.
So maybe those things are more about book sales and newsletter sales than they are about real tips in the market that people can use. I've supervised advisors over the years, and I had one particular person who I would ask him every year, what system are you using this year? Because he had a lot of really good ideas, but when you put the money to it, real money on it, it didn't work well because there's transaction costs and all kinds of other things going on. So the key is to have a strategy. There isn't just one. That's the hard part, but have a strategy that works for you that you can be comfortable with. And I like to say diversity. What diversity buys you is patience. Without the patience, you're not going to do it. Here's a challenge for all of you. We're talking about getting into the stock market, and we've all heard about buy low and sell high.
Yeah.
As the goal. But let's put that into psychological terms for a minute. So that means you have to buy when the market's off, which is the most scared you will be. And you have to sell when the market is high, which is the most elated you're going to be. And the challenge with that is it's completely counterintuitive. You know, Warren Buffett even says when you buy, you have to buy when there's blood in the water. And that's just not in our normal DNA. It's not normal in your DNA, especially just starting out, that you want to put money in a market where people are losing their shirts. But one side of that coin is people are selling, losing money. That means somebody has to be buying those.
Right.
You cannot sell if no one's buying. So when you hear everybody's selling, just click in this thing that's not true, because everybody can't sell if somebody's not buying. So somebody thinks that's an opportunity out there, and maybe at your expense if you're being emotional about it. And that's the hard part. I'm a behavioral financial advisor as well. And the biggest challenge that we have, the biggest impediment to success in investing is the investor themselves. It's making emotionally charged decisions about an emotionally charged situation. And it's definitely emotionally charged. I mean, people care more about their financial future than a lot of things. But if you make decisions based on that, you're going to make mistakes.
Which is definitely one of the reasons why we say, have a professional help you, is because you need sometimes that third party who's less emotional or knows how to manage those emotions and different things, because just because it's not their money, they still have a leg in the game and, want the best for you, but they understand how this works and have more of the mental preparedness of buy low, sell high. We were just talking about that, and buying low means, it's on sale, but everything's dropping. Where it's high, you also never know what that peak is going to be either. So people keep chasing that peak.
Yeah. And the financial professional might have more information than you have, because I've been doing this for 40 years. If you want to catch up, you got a long way to go. So it's just like our offices are just by Boeing airplane manufacturing. And I like to tell people, I don't think you want to fly in the plane that I built your wiring harness.
No, thank you.
I could learn to build the wiring harness, but I don't have that information right now. So, that's just, having said that, the hard part is this is an emotional issue. It always is.
Right.
And so the key is just not to make a lot of mistakes. And so having a financial professional can also help you take that emotionally charged situation and put a reframe on it and get a feel for more what it's, what it really means as well. So
then another thing you said already was, don't put all your eggs in one basket. So can you explain the importance of why it's so important to kind of diversify in the stock market and as well as just in investments overall?
So here's what we know long term. The evidence shows this going back a long time, and that is this: you make more money where there's more uncertainty. That makes sense, right?
Yep.
If you have a large company, let's call it Boeing, in order to change directions to respond to market conditions, takes a long time to turn that big old tanker around, right? But if you have a supplier to Boeing, smaller company, it can make shifts to things quicker oftentimes than Boeing can. Now, here's the challenge. The smaller the company, the less resources it has to do that. So what happens is you get more fluctuation potential. The more certainty is a Boeing, the more uncertainty is a small company. So what we know is this: over time, stocks do better than bonds over time. Value stocks do better than growth stocks over time, and we can talk about what that means. And small cap stocks do better than large cap stocks over time. The size difference is because of what we were just talking about. So here's what we know. We know that small value stocks are where you have the most what are called premiums, to where you can expect the most return. But if you put all your money in small value stocks, you're going to get more volatility than everything else. You may not be able to weather the storm when it becomes emotional. So that's where you need the diversity. So I was looking at a client statement this morning, and the S&P 500, when you look at how things have done, the only thing you see the news on is like the S&P 500, the NASDAQ, and the Dow Jones Industrial Average. And I think we talked about this on one other call. The Dow Jones Industrial Average only has 30 stocks in it. People don't realize that. The S&P 500 is how many? 500 stocks. Okay, so there's more diversity in the S&P 500. So when we encourage clients to look at the market conditions, to watch the S&P more than the Dow or the Nasdaq. Nasdaq is more technology focused. So having said that, the S&P 500 outperformed the rest of the market for 2 years recently, and people look at that and say, "Okay, I should have everything in the S&P." The reality is that was only 2 out of 20 that had outperformed everything else. This year, looking at a client statement this morning, the S&P was up like 3.25%, I think it was, year to date. So January to yesterday or to Friday, and their small cap portfolio was up 10 instead of 3. Their international portfolio was up 17 instead of 3. And so having that diversity is really important. And the question is, how can you access that diversity, especially if you're just starting out? We can talk about that.
Yeah, definitely. And so, yeah, if you are just starting out and want to get into the stock market, not everyone realizes that your 401k is actually already in the stock market. You're already in the market. And so what kind of tips do you have about using your company's 401k option to its maximum benefits?
Great question. And 401ks they have to provide you with some level of diversity, but what they can't do is they can't give you so many funds that's confusing so you do nothing. And so there's typically a number right around 10 funds that are available, and then you can have some target date weighted portfolios, which I'm not a fan of, and we can talk about that more in the chat if you want. So the best thing to do with a 401k if you're just starting out is get all the company's money. What I mean by that is the company provides you with a match up to a certain amount. Put in the amount necessary to get all of the matching money from the company, because guess what your return is on that money? If they're giving you dollar for dollar, that's 100% return. Yep. And that's a guaranteed return. So get all the company's money to start with. Now, beyond that, that typically isn't going to be enough for you to retire on. And so you're going to want to go beyond that because you get tax benefits for going in and so forth. But it is also the easiest way. You can build a model that has small cap, if assuming this is in your 401k, domestic large cap, international large and small. If you're young, I wouldn't put any money into bonds for now because you get a long time and you want the growth. And it's a way that even if you're only able to put away $25 a paycheck, you can still get the full spread growth model there. They might even have models built for you already. All you got to do is pick the most aggressive one. And if you're young, now the older you get, the less aggressive you want to be. You want a little more certainty built into that. So take that into consideration. But get the company's money maximum first. I mean, that's your first goal. If you're doing that, get up to maximizing the 401k. Now, to maximize the 401k, I think when you're over 50 these days, it's $26,000 a year.
Okay.
So it's quite a bit, but that should be the goal, is to try to maximize that. Now, there's a secret to that, right? First of all, once you start it out, if you put away $20,000 in your 401k, you're not going to have your paycheck drop by $20,000. And the reason is this: you're not going to be paying tax on that $20,000, and so you get a benefit from that right away. And I know people who have put away hundreds of thousands of dollars living as a janitor, working as a janitor. And the secret to that, the reason why they were able to do that, is they didn't spend everything they made. It's kind of simple, hard to do in a consuming society. But if you don't spend everything that you make, that's the way you do it. And a way to make that a habit is to start with your 401k. It'll be pulled out before you even get your paycheck.
And that's kind of the secret there is have the money taken before you even see it, before you even notice it. Just have it put aside for your future self, for your retirement self.
And when that gets to be easy to do, increase the amount you're putting away.
Definitely.
Continue to increase it at 1% or so every year or every quarter until you've gotten comfortable with it, and continue until you maxed out. And then, and that's the way you're going to set aside the most money right away. But remember, that's long-term money. So we talk about short, intermediate, and long-term money. That's the long-term money. You're not going to touch that until you're in retirement. You're not going to touch it for projects. Please don't take any 401k loans, even if it's available. It is a lousy advice. If somebody's giving you that advice, it might be possible, but it's not a good idea. So then you want to make sure you have some short-term money. You want to make sure you have that emergency fund so that if you do have, like my mother just called me today, she needs to get her car towed from her house. You don't have to go into your credit cards or into your investment accounts to pay the bill that comes from that. You want to have some money set aside that covers like your deductibles and things like that you might have. So and then the midterm money is like project money. So let's say you've got a house that you want to remodel the kitchen. That money should be probably set aside in a project money. And a client this morning asked, how many accounts should you have? And the answer is however many you need to get comfortable with the project. They asked me how many I have, and I think I have 6.
for one project or just total?
No. So I have a project account. Like I have to pay quarterly estimated income taxes. So I have an account I accumulate monthly for to pay my quarterly estimates. I have some money that's out on contract that's coming in that I want to track how much money's come in. So that goes to a separate account. I have a savings account. I have a, so accounts for different reasons, whatever it is that works for you. And those are all cash type accounts. There's no risk involved. Of course, I have my investment accounts too, and 401k and all that kind of stuff.
And so, why wouldn't you want to have that money to be able, like, let's say, for getting her car towed? Why wouldn't you keep that money in the stock market? Why do you want to keep that in like an emergency fund or in a cash, easy access area?
So the S&P for the year last year, I think, was down 10%. Let's say that's the money that you're talking about. If you didn't have money set aside that was more certain than that, like in cash or a money market account or something, then you would have to sell out on that stock market in order to pay the bill to get the car fixed. Mm-hmm. The alternative to that is put it on a credit card. And if you don't have the money to pay the card off, you could be paying as much as 24% interest on that. Yeah. So, which is a great investment for the credit card company, but not for you.
Right.
And so the key is to not pay those things that are forced upon you from accounts that are not as smart a place to pull money from, like your stock market or carry a balance on credit cards. Using a credit card, great. Pay it off every month though. Mm-hmm. Using a credit card to accumulate points or travel miles or whatever else, super. Just make sure and pay it off every month. And that just keeps the spending in check. So it's really more about a smart place to use the money. Now, if you've made a ton of profit and you want to pull some off the table and you use that to fix your car, so be it.
Yeah. But that's different.
But when you're just getting started, that's not usually the case.
Right. And so if we, you max your company's 401k options, you have kind of these short-term and then these intermediate, savings. How else can you jump into the market? Like, is this the perfect time to see an advisor, or is there things that people can do themselves, or, what's kind of that next thing?
So if you're going to go to an advisor, typically there's got to be resources there. Like us, our compensation comes from an asset under management percentage fee. And so we have account minimums, and it depends on the circumstance whether the account minimum is $250,000 or $500,000, and that's money that you're managing, not that's in your 401k.
Got it.
So typically that's, our average client typically is over 50. They've accumulated for a while, etc. But beyond that, you can go to, let's say, a Vanguard, and in a Vanguard account, you can open an account for $3,000. You can buy full spread models. They have lots of funds that are both focused on like the S&P 500 or or a world model, or you can have multiple different things there. And you can add small amounts to that. You don't need thousands of dollars every time you add. But once again, when you're adding money, set it up on what is known as an ACH transfer, set it up on an automatic program so that it's being invested whenever it's supposed to be invested. So let's say it's, you always have it set up on the 15th of the month. Kind of a popular time because most people's bills come on the first of the month. So it's kind of popular.
The second paycheck has a little extra love.
Yeah. And so you get it set up for the 15th of the month. And if the market's down, your emotional response might be, well, I'm going to wait. I'm going to time the market. Well, timing the market doesn't work. People will tell you it does. People will believe to their nth degree that it does, but I've seen it in 40 years. Timing the market is a zero-sum game. It doesn't work other than chance. And so by putting it in on an automatic basis, it's going to go in whether the markets are up or down. Right. Now, that process is a process called dollar cost averaging. And dollar cost averaging is a risk mitigation tool. That means when the markets are down, you get more of those shares if you're investing the same dollar amount. But then when the markets are up, you get less of those shares. And so your average price per share is weighted toward the lower shares, making it a little easier to make money. So that dollar cost averaging is a very important tool. But you can do that with a Vanguard. You can go in. I'm looking at a Vanguard site right now, open and maintain an account, $3,000. To add to an existing account, $1.
There you go.
So if you set it up for $25, or $50 or $100 a month, I would try to do something that creates a little bit of awareness for you so that it's a little bit of a stretch, get comfortable with it, and then expand it, just like the 401k conversation. That's how people get a lot of money in the markets that they eventually can live on. It's deferring what you're doing currently so that you can live in the future. Now, if you did it all right now and you had to blow out your 401k in order to pay for something, I've also seen people take big chunks of money out of their 401k to buy a house, for example, that they want as a second home when they retire. Huge mistake. I mean, the average person, if you pull out, just to get an average house, you pull out $500,000 for an average house out of your 401k, you've got to take about $900,000 out, pay the taxes, and then spend $500,000. It's really stupid. So
and that's the thing we kind of want to share here is that when you withdraw money from your 401k accounts, there is like a rule on top of them that you can't pull out until a certain age. Otherwise, there is a huge fee, and that's why you want to really prevent yourself from doing that. Correct?
And that, Maggie, you're hitting it on the head. It's called the premature withdrawal penalty. The premature withdrawal penalty happens when you pull money out prior to 59 and a half. There is a 10% penalty on top of the tax you pay. Oh. So if you are at a 25% bracket, you just paid 35% to pull money out. Not smart. Now, there is a way called a Section 72T exemption that allows you to pull it out for income before that. There's also a way to pull money out prior to 59 and a half from your 401k. Let's say you're retiring at 55, got lucky and great. You can pull money out of the 401k on a monthly basis without penalty doing a certain way too. But generally speaking, you're right. A 10% penalty is hefty, and that's on top of taxes. Now, if you put it into a Roth IRA, the 10% penalty applies to the gain only, and the reason is because you didn't get a tax benefit going in. So that money you put in is called basis. The money you put in is money you can take out again without a penalty, presuming you've had it in there 5 years. So yeah, there's definitely some rules, but you want to start. That's the hardest part, is overcoming inertia. Just start. If you don't have a 401k, start an IRA. Most IRAs you can start with $50 a month, $100 a month, including at Vanguard, I believe. So just start.
Yeah, it seems like once you open the account, which is probably the hardest part, set up your automatic transfer, which is none of that is overly difficult, but probably the most time consuming. But after that, it's set it and forget it pretty much. And so then from there, you want to go in and check on it when you feel that, it's an easy amount they're kind of pulling out, and you can move that up a little bit to continue raising that amount monthly. But otherwise, it's just automatic. You're good to go. And that way you keep investing for your future self.
Yeah. And to be clear, when we talk about checking it, we're talking about checking how much you're investing.
Mm-hmm.
We don't encourage clients, because we believe in a passive approach. Not everybody does, but we encourage clients not to keep looking at the value, because
Right.
all it does is it creates anxiety if the markets are up or down. It's just not helpful. We look at the whole model that we're in when there's a significant difference coming. So, for example, Maggie, I'm going to guess here, but I think you're younger than me. So
Maybe.
I'm not going to say what, but I'm guessing you're younger than me. I'm closer to retirement than you are. So if I was setting money aside for my retirement and I go to retire, that's a significant reason why you might want to change the model. When
Yep.
you're younger, and my kids are 40. So when I talk about younger, I'm talking about even their age and younger than that you got a long time before retirement comes. So be aggressive on it. Now, what does that mean? That means that you want to have some domestic stock. You want to have foreign stock also. When you invest in the foreign stock market, you're investing with US dollars. So not only do you get the performance of the companies in the foreign funds, but you also get the currency exchange too that can benefit as well.
Oh, yeah.
And but right now, if I was to do it, I would probably opt for $2 of domestic for every dollar of foreign, and have that kind of a ratio of 2 to 1. But the world, if you look at the world, more than half of the world is invested outside of the U.S. But there's something called a home bias. We get comfortable investing with things around us that we know. But I would definitely have some foreign, and they perform at different levels, and that's kind of the point, is that you want that diversity. You want some to be zigging, like my son would say, while others are zagging. So,
Right.
yeah.
It definitely makes sense, and kind of shows different ways to diversify, because if one's going way up but one's going down, they just kind of equal each other out at the end of the day, somehow like that.
And what might also happen is that one's going up and the other one's just going up, but at a different rate.
Right.
So it's not just as high, but again, they switch off. So growth and value. What's a growth stock? Growth stock is like an apple. Growth stock, technology stocks oftentimes, but Tesla was a growth stock. At one time, Tesla was worth, I think it was like 1,000 times earnings, where the average growth stock is about 20 to 30 times earnings. So by definition, way overpriced. But Tesla was going crazy, right? What's Tesla done in the last year? Yeah, and then Elon took out the money for Twitter. So whatever, right? But if you look at Tesla, just go up and look at a chart of Tesla, Microsoft, Google, Facebook. All of those have taken huge hits in the last 15 months. And that's when value stocks tended to come back as well. But over time, value stocks have done better than growth stocks. Not every year, not every time, but over time. It's the same thing for stocks and bonds. Stocks outperform bonds 2/3 of the time.
Wow.
on a year-over-year basis. But that means 1/3 of the time they didn't, right?
Yeah.
But if you look at the overall picture, stocks will outperform bonds over time, just not every time.
Which I think, bringing up that Tesla stock is a great example of, you wouldn't just want to buy one or two Tesla stocks and just track those two. You'd want to invest in more of a market like an S&P 500, where you would have a bit of everything versus that one stock, because if it plummets, you lose all that money.
Yeah. Here's the 10-year performance of Tesla.
Wow. Sounds like a very hard.
Imagine if you bought it in the 52-week high when it was $384, and it's currently selling for $169. Now, quick math says that's off about 2/3.
Yeah.
Now, we consider, it's considered a correction when it's down 10%. It's considered a bear market when it's down 20%. It's down 65%.
Yeah.
What is that? That's a crying game if you bought it at $360 a share, but it's an opportunity if you're looking at it at $169. The problem is it's $169. So to buy one share, it takes $169. You typically want to buy in blocks of 100. So that's not 1,600, right? That's $16,000 that you want to put away just to have one Tesla stock. Now, it's estimated that you need over $500,000 of individual stocks to start to become properly diversified.
Wow.
And even that's a small number, because if you start looking at international and domestic, et cetera, you probably need closer to $1 million to approach that diversity. There are things called separately managed accounts that typically have $500,000 as a minimum.
Wow.
Just to manage them separately, and that's so you can buy in through mutual funds or through exchange traded funds, and that's a whole other topic we can talk about more. But both of those are good ways to do it, and that way you can get the diversity that you want.
I love it. I feel like we've been able to provide a lot of different tips when getting into the market, and just some key kind of reminders to have of diversify and buy low, sell high, but that's kind of backwards for our brain. So just kind of think about these different things as we go to and try to invest in this new year, and kind of really start planning for our financial future.
What do you think the primary tip is? What would be the primary tip in your mind?
Get started.
It's like you've done this before.
This might not be my first rodeo, but we always just want to tell people to get started, to jump in. There's no better day than today, because really the magic of investing is the investment portion, but then time.
Yeah, get started is exactly what I was thinking, is that overcome that inertia and just get going. But then on top of that, use the tools to your benefit. So if you're not in your 401k, mistake. You should be in your 401k, taking all the company's money. After all, who wouldn't like doing that, right? Even in my company, I encourage, and good employers will encourage their employees to take all the company's money, because it's part of the benefit packages. So even in our company, our 401k, I encourage people to just max it out, and which means you're going to put more in than I will, but that means you're committed to the company. It means that you're also getting benefit to yourself. It provides a lot of other benefits. So yeah. So get started, and the easiest way to do it is you can start with 1% of salary, 1% of your income, and have that happen automatically, and keep bumping it up until you've maxed it out.
I love that. Well, I appreciate you, Dale, coming on today and providing your expertise. If anyone else has questions for Dale, wants to reach out or work with him, his email's been going through the bottom here. He's also one of our Purse Strings approved professionals, so you can check him out on our site, pursestrings.co. Are there any other parting thoughts that we need to touch on?
Just if you email me, make mention that you saw me on the Purse Strings Facebook Live event, so that I connect the dots a little bit, because I do get a lot of email.
Perfect. He's a very popular guy, so make sure you.
I don't know about that. My wife might say different, but whatever.
Oh, whatever. Well, thank you again, Dale, for coming on today, and we'll be back again next Monday with another Money Monday. So we'll talk to everyone again soon. Bye.